Pauline Gathuri is the Senior Manager, Life Insurance Business Association of Kenya Insurers, and she's our guest this hour, sitting in the hot seat of the Situation Room. Pauline, good morning.
Good morning.
How are you?
Very well, thank you. And how are you this morning?
I am fine. I cannot speak for these two gentlemen, but are they not looking fine?
How are you, gentlemen?
We're fine.
Well, actually, now that you ask, we are very well, thank you.
Thank you.
Good to have you here because we're talking about something very important. We speak about it all the time, but sometimes things seem to fly over our heads, and that really is why it's important to plan for retirement and looking at some of those pertinent issues. But before we get there, now that you've welcomed us so nicely, let's welcome you in the way in which we do it here. CT has proverbs every week from different countries around the continent. Don't ask us how he travels every week and he's able to go to different countries. It's a trade secret. He wants to share one this morning from Côte d'Ivoire. So you listen to the proverb, you tell us how you would interpret it and what it would mean to you. Is that all right?
Okay.
Okay.
I'll try.
Okay. When the eye cries, the nose does not rejoice. When the eyes cry, the nose does not rejoice.
When the eye cries, the nose does not rejoice.
No, both eyes.
Or both eyes.
Eyes, not at you, left. Both.
Okay. I'll just try. I'm not very sure, but I'm thinking it shows how we are connected. So if my colleague, my friend, a family member is going through a difficult time, it will affect me. Because if the eyes are crying, the nose will definitely also be affected.
Excellent.
Thank you.
That's it, isn't it?
Excellent.
That is it. Exactly. And, that's what we're looking at. It's great insights. So looking into a couple more insights as we're getting into this conversation, you're in the hot seat and you're telling us some very important information this morning.
Yes.
So getting off of it, let's just start with the organization that you run, the Association of Kenya Insurers. Tell us a little bit about that as we get into now some of these details.
Thank you very much. Now, the Association of Kenya Insurers, or as popularly known, AKI, AKI, is an umbrella body of all the insurance companies in Kenya. So all the insurance companies are members of AKI. So our main mandate as AKI is to promote insurance, to support the industry to grow, and also look at how do the laws affect our members, how do they affect insurance. So you'll find we'll always be at the forefront talking about issues that affect insurance. If a new law comes in that affects insurance, then we'll be at the forefront, engaging the government, engaging various stakeholders to talk about that and bring out the effects on the industry. So we also have this mandate to grow the industry and to create awareness among Kenyans on the importance of insurance and pensions.
Okay. So, and then of course, insurance and pensions also point towards a time in life when you're going to be able to need to call on that. And that then forms the crux of the conversation that we are having this morning. Looking into retirement and say, you know what, why is it such a big issue? That when it would sound obvious that maybe later on in life, you're not going to have as much vim and as much energy to do the things that you do running around up and down. So you're going to have some kind of sustenance. It sounds obvious. But then why does somebody say you need to prepare so much for retirement? Do we see as much when they say you need to prepare for birth? Actually, yes, they do. When you're preparing for birth. But those are the two times in life, when it started and when it's coming to an end that you need to be prepared for. Why so much emphasis at this time?
Okay, thank you very much. That's a very good question. So one of the things, just as you've said, everyone one day will retire. When you're young, energetic, you are hustling, You don't imagine how it will feel when you're old, you have no energy, and you cannot do the everyday things that you are able to do when you're younger. So everyone will get there by God's grace, because that's what we long for, a long life. Then the other thing you find is there's changes in the society. Some decades ago, that there was an insurance in the traditional setup where the young would take care of the old. And so the old age, the old people were well taken care of. Not anymore. The rural-urban migration, all the young people came to the city. Life in the city is quite tough, so they are not able to take care of their folks in the village. You've walked in the village, in some parts of this country, and you find an old person living alone, very needy. And so one of the things, and by the way, for our age group now, our children are not migrating to another town, they're actually migrating abroad. So in old age, who will take care of you? I think we all have a responsibility just to remember that as you're working, when you're strong, you're the only person in this world who is responsible for taking care of the older person you will become. And so that is why it's very important to do that. And then with the medical advancement, people are living longer. If you look at the average people, once somebody hits age 60, most people are very likely, there is a very likelihood of people going for another 30, 40 years. And we've seen a lot of 90-year-olds who are looking good. The other day, there was something in the paper about a 90-year-old man who was celebrating his 90th birthday by climbing Mount Kenya. You can't do those things if you don't have the money. So as you're working now, just know that after age 60, maybe when you retire, or when you're old and you can't work anymore, you will still have another 30 years to live. And remember, your expenses will not retire with you. Expenses will continue. You still need to eat. You need medical care. You need all these, pay your electricity, your water. So those expenses will not retire because you have retired. They'll continue,
Yes.
And then the other big advantage we also find is because the government has realized this, because if somebody does not plan for their retirement, they also become a burden on the government. We've seen even the government coming with policies to support old, needy people with the cash transfer to Wazez. I think they give them 2,000 per month.
Yes.
And that is hardly enough. You can imagine 2,000 per month when you're 80 years old. It won't help. So what the government has done is to encourage us when we are younger, when we are working, by giving very wonderful tax benefits. So it's very rare for the government to give you tax breaks. But for retirement planning, they have, it's there in the law that up to 20,000, you can save up to 20,000 shillings per month. That is about 240,000 per year, tax-free. So you deduct it from your tax. So if you're not in a retirement, if you're not already in a plan where you're saving towards your retirement, you're actually losing tax benefits. And everybody wants to keep their money safe from the taxman in a legal way. And maybe the other thing I would also mention is, it's very good for us to remember that when you're old, who will take care of you? How will you take care of yourself? Now, there's some research. We have a regulator called the Retirement Benefits Authority. They have done wonderful research, which they do every year. And one of the things the latest research has shown is that out of all the working Kenyans, which is about, that translates to about 27 million Kenyans who are working, only 26%, that is about 3.5, have in any form of a retirement plan, are saving intentionally for their retirement. That is a very sad or scaring statistics for our country.
Why do you think that is, if I can interject, Pauline? That it would seem, from the things that you said, it would appear that it would be obvious that, okay, so you get older, you don't have as much energy as you did before, you don't have as much in terms of opportunity to take care of yourself. And yet, if they have an opportunity presented itself for you to keep a little bit of something aside, still people don't. Why do you think that is?
I think one of the reasons is because people are not aware. As we create aware, as we tell people, then people will realize, oh, what will I actually do? I think most of us, we just concentrate on the short term, the day-to-day living and survival, and we don't think about that life after. Because when you actually look at it, most of us just have the advantage of working for about 30 years, maybe between age 25 to 55 or 30 to 60. After that, you have another 30 years to live. So within this period of 30 years, you have to survive that 30 years. You have to take care of maybe a family if you have, but you also have to save for the other 30 years after that. Yes. So I think it's that creating awareness and telling people you need to prepare. And I think in the proverbs you've shared, in every country, every tribe, there is a proverb about planning for the future. Yes.
There always is. What you're referring to is a culture that has not taken root in this country. Because for the longest time, the old age insurance for many Kenyans was their children. But then it becomes a bit of a problem, a sticky one at that, when you consider that we still have a very large population of Kenyans in the rural areas, and they don't have what you may call formal employment. And if they are farmers, incomes in farming are seasonal. How then do you marry these two? How do you get someone who, for instance, is predominantly a subsistence farmer to be able to understand the need for saving? And how do you get them to understand that this income they have, meager as it may be, can also be saved? Because that would be the big problem. Many people retire and go to the rural areas, and try to settle in. Many don't live long once they do that. And it is for the reasons you've said, they haven't planned for it. But then there are some who never were in town. They were always in the rural areas. Now, with all the difficulties, from my observation, they seem to cope. They seem to have found a way of surviving with the difficulties that they have. But the culture that I speak of is not there. How do you get people to actually understand and embrace this culture? Yes. So that it begins with saving, putting money aside. Because these retirement benefits are just that, it's an investment. Yes. How do you get people to understand this need and to actually apply themselves to it?
Okay. Thank you. Thank you very much. Actually, your observation that people who have always lived, if somebody has always been the farm, somehow they'll cope better than somebody who has been in town and then settles there, because then they don't have any income. They don't even know how to farm. So I think the culture that people, that's how we can change this culture is just talking to people, educating them about, remember you are getting there, how will you cope? Creating that awareness, because many people are oblivious of what will I do when I'm this age. And one of the things is educating people, telling people, challenging people, put some money aside for a rainy day. When you're old, you can't work. And I think it's also something that is really affecting maybe the young people, where they feel like I'm too far from retirement. And one of the things I would like to just tell people is that when you have a plan in place, it somehow guides how you spend your money, the money you earn. Because if you have this plan, when you're making a decision on where to take your child to school, that plan will guide your decision. Because instead of taking my child to a very high tier school level, I will maybe settle for a middle level school, because then I have this plan and I'm saving my money. If I'm thinking of shifting houses to a more expensive house where I'll pay maybe 60,000, I'll say, no, let me stay in the 30,000 because I am saving towards this. If I want to change my car and I don't have a plan, I'll just change it without thinking. But if I have that plan where I'm putting money aside every month, then I will be able to first stick with my car.
Okay.
And one of the things you find is to always remind people your children cannot be your retirement plan. If you plan on that, that's why maybe we have a very huge problem of black tax in Kenya. Do you want to continue that tradition to your children, or do you want to end it with, because you had to maybe take care of other people, make it easier for your children? I don't think it's fair for a parent to not plan for their future and then expect the children to take care of them.
Well, they say failure to plan is planning to fail. So perhaps those guys of my generation who might see retirement as too far, we definitely have to think with that in mind. Let me get technical just a little bit. When is the best time to start claiming your retirement benefits? Because we have instances where individuals withdraw their pension funds before attaining the retirement age. So talk to us about the riskiness in this particular move, and equally, is there a fee, at the end of the day, if you withdraw your funds before getting to that age, is there a fee imposed on you? What's the percentage?
Okay, thank you. So, and thank you for bringing in the anchor of the young people. One of the things I tell young people is the best time to start planning for your retirement was yesterday. The next best time is today. And when you're young, you have time on your side, and they talk about compound interest as the eighth wonder of the world. So when you're young, you can take care of that, and just by putting a little money, 1,000, 2,000, you can find that by the time you get there, you've really built a very huge fund. So maybe to answer your question on how do I then the withdrawal before retirement, what happens is, especially among, again, the young people, there's a lot of job hopping, which is good. Today you're earning this, you get another job, so you get to the next job. But the mistake that people make is whatever pension money, if I'm in an employer scheme, I had accumulated, then I withdraw that and eat it, and then go to the next job, start building the fund again. So you find that is counter. It's counter productive because of the plan you have. So what the government has done, again, according to the RBA rules, they now came up with a rule where you can only withdraw up to your own, you can only there's a portion of the employers that has to be left in the scheme. So you can only withdraw because you are contributing, yes, and the employer is contributing, so you can withdraw your own. But the employer's fund is left there. And I know RBA have been fighting that rule and saying they want to change it so that money is locked for you at least until age 50. When you can take early retirement, or if somebody is retired on ill health, then they can access the money. So because the purpose of this money is for you to save for your retirement. Yes.
So, just segueing from that, what are we looking at then? What are we saying? I read somewhere, I'm not really sure of the details, but it becomes formulaic in nature. That you're saying, look, if you're earning this amount per month, whatever the case may be, that there's a certain percentage of it that you need to take and put away for this time that we're talking about, when you get to 60, 70, whatever the case may be. And that if you do that regularly over time, you will then have an adequate enough of a nest egg for you to live off of the rest of your life. Is there a formula for that? Or do you just, wing it and say, let me just put something aside, it'll be enough for me?
Okay, thank you very much. I think maybe that question, let me first start and just mention very briefly about the types of how you can save, then it will answer that question. So we have three main vehicles for saving for this retirement. So the first one is the government-sponsored schemes. We have the NSSF, By law, every employer or the employees need to be in the NSSF scheme. Traditionally, as you've seen, NSSF employees contribute 200 shillings, employer contributes 200 shillings. And many people say, I don't need to plan for my future, for my retirement, because I have NSSF. Most people you talk to after working for between 30 and 40 years at retirement without the NSSF scheme, as it was before beginning of this year, they would go home with 200,000 shillings after 30, 40 years of working. So, of course, that is just peanuts, and it can't even last you for 1 year. Now, there's a revised, the NSSF Act was revealed and reviewed, and now there's the amounts were increased. It works out to about 6% of your pay. 6% of the employer contributes 6%, and you contribute 6%, of course, subject to some limits. And it's normally divided into two tiers. Tier 1, where you contribute now I think 720, and then tier 2, the balance of the money goes to the tier 2. But one of the biggest advantage that Act recognized is that the tier 2, the bulk of the savings, you can transfer it to your private pension plan.
Okay.
Yeah, you don't have to put all of it there in case you're having doubts. So that's one of the government schemes. Then for all civil servants, they are in their own government scheme. So the other one that I'll talk about is the employer-sponsored schemes. Like I know here you have an employer-sponsored scheme where you contribute, every employee contributes to the scheme, and the employer also
matches
contributes.
it.
Yes. So for most employer schemes, the contributions are between either 5% to about 10% of for each. Some will be 7%. So that's about 14% of your salary, which works out to a good earnest at retirement. Now, for many people, because we know that most people in Kenya are employed in the informal sector, in the SME sector, about 80% of the working population. So for these people, where the employer may not have have set up a retirement scheme, then we have the individual pension plan, and this also works for self-employed people. It's a perfect product for them, the individual pension plan. So with this, you have now, it's also registered with RBA. You enjoy also the tax benefits that are also open to all the other schemes. And what happens is now you can, so with the individual pension plan, it's now flexible.
Okay.
I mean, self-employment. These the first 3 months of the year, maybe my business is doing well, I can decide to put in more money. Maybe 10,000 every month. Or I can even, 1 month I make a lot of money, so I put in 50,000. Then I have a dry spell. I take a break. I'll just continue again when I get money. So it's very flexible. That one you decide the amount yourself based on what you're able to save.
Yeah. A lot of people are asking the question, what's the difference between saving and investment? So should you take that money and invest it somewhere so that it can grow something for you in the future, or you should just take it and put it under your mattress?
Mattress is good.
Is it?
Lots of dangers in the mattress. It can be stolen.
It can be burnt.
It can be eaten by a rat. And it will not add money for you, interest. And it's also very accessible to you. So you won't last with it for a week before you go and spend it. Yeah.
Jesse?
Let's say I've managed to put, I'll just speak a random figure, around 5 million Kenya shillings in my pension. Give us a breakdown in terms of the amounts one might expect once they retire, monthly deposits, vis-a-vis the general amount you've been able to save through contributions, yourself and the employer. And equally, when it comes to that particular point, do you need to follow up your money? Do you need to go line up, or is the process seamless? Are there monthly charges once you start withdrawing your retirement pension funds? Yeah.
Okay, thank you very much. So I think the way to answer that question is to also explain how the scheme works. So once an employer starts a retirement plan for their employees, a retirement scheme, it no longer belongs to the employer. It's now a separate entity, and it is regulated by the Retirement Benefits Authority. And the employer is under an obligation, legal obligation, to deduct from the employee, match the amount, and forward it to the scheme. And the scheme the members appoint trustees who then act as the legal owners of the scheme. So one of the very interesting cases we've had in the industry is when maybe an employee is sacked because of an issue, and the employer then says you can't get your pension. That RBA has come up very clearly, and they cannot attach your pension benefits. That does not belong to them. If the employee has done something else, like maybe stolen, please follow the legal way, recover your money, but do not touch, because pension monies are non-assignable. No one can take your pension
and
benefits.
attach them to something.
Yes, or
Okay.
you've not paid SACCO loan, so people attach. It's not possible. The law is, it's a really protected fund by law, so that no one can access that fund and use it for another purpose. It's only for you. So what happens is these pension schemes, we have different types, like all the funds managed by insurance companies, like the personal pension plans I've talked about, the employer schemes, they are called guaranteed funds. Again, they are guaranteed by law. Regulated by two regulators, the Insurance Regulatory Authority and also the Retirement Benefits Authority. So what happens with this guarantee, your capital means the monies you have actively put into that scheme is guaranteed. So I could not have put 100,000 and then I'm given a statement at the end of the year, my money is 95. No, the 100 is guaranteed. Then there's also a minimum rate of return, which is guaranteed. Currently, it's about, some companies give 5%, others give 4%. That is guaranteed at law through a contract and through the acts. So what happens in a guaranteed fund, the insurance company takes the investment risk. So they are the ones investing, they take the risk. If they lose the funds, the law has a way of dealing with that, because the insurance company is supposed to put a lot of assets to match those funds. But most of the interest rate they declare at the end of the year, if you look at the average of even last year, it was about 11%. So what happens is with these guaranteed funds, so you every time, because most companies now will have a portal where you can access your statement and see how your fund is growing. But with there's another form of way you can save for also your retirement. Some schemes are segregated. So with segregated schemes, you as either the scheme or you as the individual, you carry the investment risk. So if the markets go down, so that's the main difference between the segregated funds and the guaranteed funds.
Okay. The majority of people, if we're looking at Kenya today, a majority of the people are not in this employment where it seems as though you can then break things down, that a particular amount of your salary is then put in this bin and something is put in this bin, and then you have pensions and it's matched and all these other fancy things. Majority of people don't have access to that. But we're saying that everybody at some point or another needs to have something that you can rely on for the future.
Yes.
Whether we're looking at a semi-urban, urban, rural population.
Yes.
What about those who are not in formal employment? What about those who want to be able to keep something for a rainy day? Because if you look at how things were done traditionally, is that there was food because you live right next to it. So you don't have to worry about when you're older where you're going to get it from. There was community. You're living in the community. So communities took care of one another. But now we're living in a more insular, segregated community society whereby every man for himself and God for us all. But we're saying that still you need to have something for a rainy day. How do the people who are not in formal employment then take advantage or even start to think about these opportunities for retirement?
Okay, thank you so much. And that's why we talked about the individual pension plan that is specifically designed for somebody who is in self-employment, someone who is not in a regular employment, and they can be able to decide how much they are able to put aside according to their income. And maybe to come back to his question, so what happens? This money grows. You are able to, even in a personal pension plan, you are able to track how your money is growing. And remember, I talked about the tax benefit. So whatever money you are putting into this scheme, you are putting it, you are enjoying tax benefits of up to 20,000 per month. And then the investment income that is earned by these funds, the pension funds, is also exempted from tax. So in other words, your statement will never show a deduction because your capital is guaranteed, the interest is guaranteed, and there is no tax.
Yeah.
And that is a question where many people come and say, I could also invest in something else. Like I'll give an example of the money market funds. They are good. It's a good investment vehicle. I also have one. I enjoy it. But what you find, the money market should be for shorter to medium term needs. Like I want to buy a house, I want to save secondary school fees, and with the money market, I'll save it from my after-tax money, after I have paid tax. The interest I earn from the money market is again taxed. And again, this money is accessible to me. I could just decide all my friends are going to Dubai for a holiday, peer pressure. I decide to pick it and go. So you can use that for other investment needs, but for retirement, we always say the best thing is either the individual personal pension plan, or if you are in a case of employment, then you save with the employer schemes. When it now comes to retirement, the law allows early retirement from age 50. But you're the one to decide when you want to retire if the employer does not push you out. In an individual case where you're self-employed, you're the one to set your own retirement age. So at that stage, we have two types of schemes. We have the pension plan and we have the provident fund. A provident fund, your whole fund is taken, you're given the money, so you're given 10 million, 12 million, 20 million, whatever you've built. You've never handled such money so fast, you go into confusion. As you decide what to do with the money. And research done by RBA has shown that the people who take a lump sum at retirement, that money doesn't last them 2 years. So the other scheme in which the law and RBA encourages is the pension plan, where you're allowed to draw out a third of the money. So if it's 10 million, it's about 3.3 million that you can go and do games with and, try your business. But the other 2/3, you are allowed to either take it now as a regular monthly payment that will pay you every month until the day you die. And that is called an annuity. Or you can put it in a fund called an income drawdown, where you draw a certain amount, up to a maximum of 12% every year for a period of 10 years. So when it comes to withdrawing your pension at the withdrawal stage, there are no stories. The law is very clear, the RBA Act, within 30 days, funds should be paid to a member. Yes.
So all these things we are speaking of, we will conduct them through an insurance company.
Okay. Yeah. Yes, all these the pension funds I've talked about, we have segregated, which can be done by fund managers, and we have guaranteed funds, which are strictly managed by insurance companies. Most of the individual pension plans in the market, which are regulated by RBA, are actually started by insurance companies. Yeah. Yes.
In the unlikely event that the insurance company goes under, what happens?
Okay, that's a very good question. We've seen some companies going under over some years. But one of the things I would like to challenge you on to check is that all of them were actually general insurance companies. Life insurance companies are required by law to build a life fund, which is the insurance company is required to have assets in excess of the liabilities that the life insurance company holds. The only company I can tell you that went under, it had a life part of it was Kenya National, which is very many years ago, and all the people who had life policies or even pension funds were paid up, because the fund was the life fund, which was already protected, was taken up by the regulator, IRA, and they paid off every single person who had either a life policy or pension funds.
Sorry, Pauline. I just in relation to that, because I think sometimes it befuddles us, and so we get a bit confused. When you say, because that's the fear for a lot of people, isn't it? That you're going to take your money and you're going to put it somewhere, and then somewhere, whatever voodoo is done, the thing disappears. So when you say that they're required to have an asset base
assets in excess of liabilities.
In excess of liabilities. So when you say that in English, what exactly are we saying now? That the money that you have as the insurance company should be more than the monies that the different individuals who are part of the scheme collectively have. So if all of us were 1,000 and we have 1 billion shillings that we put there, the insurance company, not our money, should have their own money in excess of 1 billion.
5% in excess of
1 billion. Okay,
all right. So in case anything goes wrong, then the regulator has an asset that they can then pick, which is mainly in government securities, to pay off the 1 billion funds.
Okay.
Over what period of time were people who had this sort of facilities with, say, Kenya National Insurance paid?
I know what took long was the changeover to appoint they call to appoint a manager to what is the name of that, for the regulator to appoint a manager to oversee that process. A receiver manager, thank you. But the process of paying off took about 1 year. Once IRA appointed a receiver manager, the receiver manager was able to look at, because you have to call in auditors and to check the books, but it took 1 year for IRA now to pay off the people who had funds.
See, the reason I ask this question is because banks now in this country also offer insurance services, not necessarily life, but they do. And some even have branches that offer insurance services. But we've seen banks collapse, and we have seen the pain that people who had money in those banks have gone through. Now, I don't know details of how they were paid, when they were paid, when it was settled. Yes, there is a deposit fund that I know exists, which enables you to receive your money, but it is received in installments over a period of time. It isn't a lump sum. And the installments are usually very meager amount. I'm saying meager, depending on whatever it is that you had and how they're paid. So when it comes to understanding what it is that one is protected against, I would then think that the insurance companies who offer the sort of facilities that you're talking about need to have a very large pot of money, meaning they need to have very many clients. Is that not so?
Yes,
okay,
yes.
Now, now this leads me to my question. What efforts are made to ensure that all these things that we're saying here are understood by people long before they even start working, long before they start earning money? Because if the seed is sown then, when they begin work or when they're able to earn, in a country like ours with a very large population of young people, you'll have a very, very huge base of depositors and people who are not going to be retiring in the next 2 or 3 years. Yes, because if it is my generation, if we retire and we want our money, somehow the insurers and the people who are in this business have to find people who will be, and the people exist. What efforts are made to ensure that this group of individuals understand these things so that they can also join and be part and parcel of these processes?
Thank you. One of the things I need to reiterate is that one of the most protected funds in this country are retirement funds. And you can talk to people who are in that field, even like the regulator, RBA. You'll find that that is one of the most protected funds in the country. But I like your idea and what you're saying about how do we get this message to the young people so that even as people start working, they already know I need, and like that is what actually happens in the developed countries. Yes. You find even by the time somebody leaves school, first job, they already have started saving in their, is it for
401k, and everybody making noise about the 401k.
Yeah, they really talk about that. Yeah. So one of the things we did, and I know even the regulators, especially RBA, have been very active in that, is partnering with KIC, the Kenya Curriculum Development,
KICD,
to develop, to introduce that kind of education to children through the curriculum, so that even as our young people are growing, they then understand the need for saving. And when you actually look at the statistics, it's quite sad that Kenyans, as a country, our saving rate is about 10%. That out of all the income every Kenyan earns, if you do an average, it's 10% that we save in any form of saving.
It's not good.
Some countries have 50, 60%, you know. So it's something that we need to work on, because I think Kenyans, then we just eat for today and say, Kesho will take care of itself.
Black tax.
So yeah, the black tax. Yes. And we have to end this culture of black tax by planning for our future, so that we make it easier for our children. So we are having those efforts of engaging even the children at primary, secondary, even the universities, so that we're able to actually cultivate that culture of you need to save, and especially talking to the Gen Zs, because they are really in that space of now starting to earn. Telling them, yes, it's good to do your sherehes and all that, but please also remember
yeah, I got the message.
Yeah, also remember to save for your future, because the saddest thing, and somebody has said, is to be old and needy. In fact, somebody said you can afford to be young and without money, but you can't afford to be old without money, because then what do you eat? What do you go to the doctor with? How do you really owe yourself that responsibility, each one of us, to take care of the older person we are definitely going to,
and that is yourself.
Yes.
So what happens at that age where because there's some people who are really prudent about this, and then that's the hope, that everybody will be able to put something considerable away, so that you don't have to think, so that you could live at that time the way you did now, in the sense that you have enough to take you through. You talk about these funds being protected by law. Government has really gone, above board to make sure that nothing can touch these funds. So in the event that something happens to you, God forbid, later on in life, when you have these funds aside and that life ends and these funds have not been used, what happens to them?
Thank you very much. So for every scheme, whether individual pension plan, whether the employer scheme, the first thing as you're joining that scheme that you're given is a nomination of beneficiary form. And that one you renew it every year, because I could have joined when I'm not married. Now I'm married, I have children, So every year you update it and nominate the person that you want to, in case of, as you said, death, God forbid, but in case of death before retirement, then there's somebody that these funds can be paid to. And again, it's quite a smooth process of this was the person you nominated and the money is paid to them. That is if somebody dies before retirement. Now, if it's after retirement, I said that there are two options. You take the 1/3 amount, that one you can go and try your business. And then with the 2/3, you then are required to either buy an annuity. An annuity is in exchange for this lump sum of 2/3, it's like a monthly pension. And we've actually seen, if you go to any of the rural areas or any setup, the people who live very well and live longest are teachers and government employees. Have you seen that?
Because they've kept...
Why? No, because they have a monthly income. Yeah, which other people don't have. So you find that they live very well because of this monthly income, because every month there's some money coming in to cater for your needs. That is what we are encouraging every person, even if you're in self-employment, create that monthly income for yourself in your old age. So once you have that monthly income, what we say, like with the annuity, you buy it, and it is guaranteed for life. So it's payable for life. For as long as you live, even if you live to 100, 120 years, it's payable every month. But we have what we call a guaranteed period. Let's say the deal is about 10 years, so that in case somebody retires and then dies by year 2, then their beneficiaries can then enjoy the balance of the 8 years that is there in the guaranteed period. That can be taken either as a lump sum. Again, you just collapse it into one lump sum and pay off the nominated beneficiary, or you pay it monthly. They continue earning that monthly for a period of 10 years. And one of the things we find, then you can either choose the annuity way, which pays you every month until death, or you can choose the income drawdown option, where you put your fund, it is invested, then you draw down a little of it every year up to a maximum of 10 years. But the risk of that, you can easily outlive it, because if you exhaust it in 10 years, what do you do then after age 70, 80?
Yeah.
You die.
Wow.
Like that. Yeah.
So, I mean, it'll be interesting to see what efforts are made to really spread the word around the nation, because, I mean, you talk about a very small percentage in terms of penetration of this information and knowledge and understanding. But, I mean, it's good steps. It's good steps that are being made. And we want to thank you so much for being here this morning to, just remind us of the importance of that for the future. And the hope is that more people will pick up on this. Whatever you have, put it aside to make sure that you can actually survive in the future. So thank you very much for that. Pauline Gathuri is the Senior Manager, Life Insurance Business, the Association of Kenya Insurers, this morning looking at the importance of getting literally our ducks in a row. Asante Sana for being in the hot seat of the Situation Room this morning.
This is the Situation Room, the only way to start your day.